Understanding the mortgage payment structure. A mortgage is a long-term loan designed to help you buy a house. In addition to repaying the principal, you also have to make interest payments to the lender. The home and land around it serve as collateral, but if you are looking to own a home, you need to know more than these generalities. This concept also applies to business, especially concerning fixed costs and shutdown points. Key, ta- Key takes away. Mortgage payments are made up of your principal and interest payment. If you make a down payment of less than 20%, you will be required to take out private mortgage insurance, which increase your monthly payment. Some payments also include real estate or property taxes. A borrower pays more interest in the early part of mortgage, while the later part of the loan favors the principal balance. Making a large down payment will immediately boost the equity in your home history. Just just everyone who buys a house has a mortgage. Mortgage rates are frequently mentioned on evening news, and speculation about which direction rates will move has become a standard part of financial culture. The modern mortgage came into being in 1934 when the government, to help the country overcome the Great Depression, created a mortgage program that minimized the required down payment on a home, increasing the amount potential homeowners could borrow. Before that, a 50% down payment was required. In 2022, a 20% down payment is desirable mostly because of your down payment is less than 20%. You are required to take out private mortgage insurance, making your monthly payments higher. Desirable, however, is not necessarily achievable. The mortgage programs available that allow significantly lower down payments, but if you can manage that 20% of 20% you definitely should. Calculate your monthly payment. Your monthly mortgage payment will depend on your home price, down payments, long-term property taxes, however, insurance and interest rate on the loan, which is highly dependent on your credit score. Use the inputs below to get a sense of what your monthly mortgage payments could end up being. Mortgage payments. The main factor determining your monthly mortgage payments are the size and term of the loan. Size is the amount of money you borrow, and the term is the length of time you have to pay it back. Generally, the longer your term, the lower your monthly payment. That's why 30-year mortgage are the most popular. Once you know the size of loan you need for the new home, a mortgage calculator is an easy way to compare mortgage types and various lenders. PITI Mortgage Payment Components. There are four factors that play a role in the calculation of a mortgage payment: principal, interest, taxes, and insurance. As we look at them, we will use a $1 lakh mortgage as an example. Principal. A portion of each mortgage payment is dedicated to repayment of the principal balance. Loans are structured so that the amount of principal returned to the borrower starts out low and increases with each mortgage payment. The payments in the first years are applied more to interest than principal, while the payments in the final years reverse the scenario. For our $1 lakh mortgage, the principal is $1 lakh. Interest. Interest is the lender's reward for making a risk and loaning your money. The interest rate on a mortgage has a direct impact on the size of mortgage payment. Higher interest rate means higher mortgage payments. Higher interest rate generally reduce the amount of money you can borrow and lower interest rate increase it. If interest rate on our $1 lakh mortgage is 60%, the combined principal and interest monthly payment on a 30-year mortgage would be about $599 or $500 interest plus $99.55 principal. The same loan with a 9% interest rate result in monthly payment of $804.62. Taxes. Real estate or property taxes are assessed by government agencies and used to fund public services such as schools, police forces, and fire departments. Taxes are calculated Taxes are calculated by the government on a per year basis, but you can pay these taxes as part of your monthly payment. The amount due is divided by the total number of monthly mortgage payment in a given year. The lender collects the payment and holds them in until the taxes have to paid. Insurance. Like real estate taxes, insurance payments are made with each mortgage payments and held in escrow until the bill is due. There are comparisons made in the process to level premium insurance. Two types of insurance coverage may be included in mortgage payment. One is property insurance, which protects the home and its contents from fire, theft, and other disasters. The other is PMI, which is mandatory for people who buy a home with a down payment of less than 20% of the cost. This type of insurance protects the lender if the borrower is unable to repay the loan. Because it minimizes the default risk on the loan, PMI also enables lenders to sell the loan to investors who can have some assurance that their debt investment will be paid back to them. PMI coverage can be dropped once the borrower has at least 20% equity in the home, while principal, interest, taxes, and insurance make up the typical mortgage. Some people opt for mortgage that do, do not include taxes or insurance as part of the monthly payment. With this type of loan, you have a lower monthly payment, but you must pay the taxes and insurance.